Welcome to Property Deconstructed with Mark Ericello from Master Advocates, and I'm Pat Panetta from Tell Your Story Media. And we've moved to this side of the desk for this one here, Mark. So I guess for somebody, listeners who've just joined us, this is a property podcast and videocast where we share information, we bring in experts, and we just try to help people when it comes to buying and selling and just getting to know property better.
Yes, yeah, and great to see you again, Pat. Thanks for having us, and we've got some special guests again to share their insight and wisdom.
Yes. Well, there he is on the screen. It's Mike Mortlock, and Mike is from MCG Quantity Surveying, and he's a quantity surveyor.
Yes.
And he joins us now. G'day, Mike.
G'day, Pat. Hey, Mark, how you going?
Good, mate. Good to have you.
Yeah, thanks for coming on.
I'll let Mark fire off the first question. Off you go, Mark.
No, Mike, we've known each other for some time, and Mike's fantastic. Quantity surveying is something that, especially in real estate, our clients, not just rental investors, but people for many different reasons. I wanted to expand on the benefits, the values and benefits of quantity surveying, and where it can help people maximise their property potential and understand value of property as well. But Mike, if you're also an affiliate member of REBA, the Real Estate Buyers Agents Association of Australia, where we first met and assisted our clients as well. But yeah, thanks, Mike. If you can expand a little bit more on, I guess, the benefits and why people should look at quantity surveying first for tax depreciation schedules, maybe we start there.
Yeah, that's probably the most obvious one for property professionals and property investors. So at the end of the day, what we do is we help property investors pay less tax. So that makes us pretty damn popular amongst that cohort. If you think about tax depreciation from a functional perspective, like a valuer, right? A valuer will get some instructions. They'll go out and inspect a property, take some photos and notes, and come back and provide you with a report. And a valuation report is going to tell you what the market value of that property is. The way that we work is quite similar, but we're looking at all of the improvements to the land. So the land has no value in our reports. It's just that convenient thing that the really important stuff sits on. So we estimate the construction value as at the time that it was built, and we look at all of the fixtures and fittings, and from there essentially provide you with a report that shows you how much depreciation you can claim each financial year, and that'll come off your taxable income. So if you're earning $100,000 a year and the report shows $11,000 worth of deductions, then you're really only paying tax on $89,000, and that's probably going to save you around $3,800, $3,900 from your pocket. So that's the whole point of tax depreciation.
Oh, thank you.
So are many people missing that, are they? If we don't engage your services, am I missing this opportunity to depreciate my asset, and I'm paying more tax when I don't have to?
Yeah, exactly. One of my industry colleagues has sort of coined the phrase "don't tip the tax man," but essentially that's what you're doing. And I always make the argument: look, if you want to throw that money away, then give it to a charity rather than the government, because they're just going to buy submarines with it. And we all know that they bungle those sorts of things up on the regular. Yeah. The first time we analysed the data on this, we looked at 1,000 residential tax depreciation schedules that we did for clients, and we found that 6.7% of people waited too long to get in touch with us. So to give you context behind that, you can backclaim 2 financial years worth of deductions. So we found that 6.7% of people came to us after those 2 years, and the average amount of deductions that they missed out on was 20,537. Now I can remember that figure from years ago when we crunched it because it was so horrifying for me. And then a media person who is schooled in the art of clickbait said, well, why don't you extrapolate that across the investor population? So we did, and it equated to $2.88 billion worth of deductions floating out there in the ether unclaimed. And what I think makes it even worse is that these are people that eventually came to us, right? We could only analyze data that came through our doors. So there's potentially a lot more people out there that have just never gone to a quantity surveyor, much less a little bit late.
I think that's really insightful, and especially if you're looking at an investment property and beyond the yield, sometimes that could be the additional contribution that you need. Those savings precisely could make the difference between getting serviceability for the next loan or the next investment property, or helping service your current investment, why wouldn't you save on tax when, taxes, interest rates are higher, land taxes are high. There's, in Victoria especially, there's so many, property taxes. It's about 53% of the total revenue for the government. But you're a national service, MCG Quantity Surveying as well. So you'd see, I guess, this across the country.
Yeah, absolutely. And I've got to say, you Victorians really know how to treat your property investors well.
We know how to tax here in Victoria, that's for sure.
I love that phrase, don't tip the tax man. It's, like was it Kerry Packer that said, if you don't want to save on your tax, you got to have your head read. So.
You got rocks in your head.
The Senate inquiry. Yeah, good to have your head read. Yeah. I was thinking that Senate inquiry because the last one was Qantas and Alan Joyce. He had that dramatic Senate inquiry, and the one before that, which had a bit of drama, was the Kerry Packer one. My normal tax accountant, is he or she doing this service, or do I need an expert or a specialist like you, being a quantity surveyor?
Yeah, it's a good question. So accountants are very, very specialised in what they can do. We are registered tax agents, but we don't do any accounting services. So the real difference with the accountant is that they can take a known cost and depreciate it. So say, for example, you've already had a depreciation schedule and you add a split system to the property. You can give that to your accountant and they can work out the effective life of that and the depreciation rate. What they can't do is estimate construction costs. So if you're undertaking a major reno and it doesn't break down all the individual items, you might need us to tease that out. But of course, if you're buying a second-hand property, the accountant has no idea of how much it would actually cost to build that property because they only really get the purchase price, which is made up of the land value, market premiums, and all those sorts of things. So that's sort of where we diverge.
Yeah, so they can help with the subsequent improvements or value adds later on once you've got the base tax depreciation report.
Yeah, exactly.
Yeah. And I actually, other than investors, I had a question that just sprang to mind was, post-COVID, a lot of, small business owners, their principal homes also become a home office. If this might be more of a tax question or asset, protection with solicitors, but if the home was already in a trust and selling, I'm pretty sure capital gains tax will be applicable if the property's in a trust anyway, then would it serve someone that's owner occupying and the home's already in a trust to get a tax depreciation schedule for the portion of the home they're operating as a business? Would
absolutely,
that be beneficial?
you can. And I mean, people that, let's say, live in a property, but they rent out a bedroom, they can actually claim depreciation deductions based on that portion of the property that they rent out. Okay. The home office scenario, actually, there were some changes in tax legislation during COVID because I think the government foresaw that there's going to be a lot of people working from home. So there used to be some quite arduous requirements, like there had to be a separate entry to that office area. Those all really changed in the last couple of years. So you definitely want to get accountants' advice because it will have capital gains tax impacts. But in principle, yes, if you're renting out a component of your home or you're using a component of your home for business purposes, then yes, you can claim deductions based on that.
Oh, that's good. Yeah, especially now, even I guess even principal tenants now with the housing crisis and rental shortage, that may be something that gets explored more with property owners. Yes,
because you've got a tenant living in a room in your house.
Yeah, or subletting if you're owning the home and living there. But I guess principal tenants might even look at exploring things like that as well.
Yeah, I mean, that's probably a little bit outside my area of expertise because they don't necessarily own the asset.
Yes.
So the owner of the property would be able to claim deductions because they purchased that and they own it. But whether there is some tax allowance for people that are subletting, I'm not sure. But an interesting question.
Yeah. Well, definitely owner occupiers renting out a room. I know even our own clients, first home buyers, they're looking to get ahead of the interest. Sometimes if they're on their own and they've got a 2-bedroom, they'll buy, occupy and rent out a second room and second bathroom.
Yeah. And it's all about sort of cash flow and serviceability, isn't it? I mean, it's a very difficult time for most people that are on a variable interest rate and most people that I think probably are even fixed, with inflation and the cost of living. It's been an issue for quite some time. And I think that's the real value proposition from a depreciation point of view. And if you think about investing in a property, the hardest time to hold on to it is in the beginning, because over time you may pay down some of your principal. Over time, you would expect that your rent will go up. So the property might move from a negatively geared to a positively geared property in time just naturally. But the benefits of getting depreciation in the upfront is that you're getting that tax back at that first period where serviceability is the hardest in that property.
Property Deconstructed, we're chatting with Mike Mortlock from MCG Quantity Surveying. Mike, we'll go away for a tick and come back with the next episode and get Mike back on the second one.
Yeah.
Shall I drop a question and then we'll pick it up next time?
Yeah, definitely. There's a lot to expand on, and we'll if you're happy to stick around for a second episode,
sure,
Mike, that'll be great. But yeah, Pat might throw in some extra questions as well.
Absolutely. I want you to think about this one. So you're a national business. If you were to purchase a property in any state or territory in Australia, what would be your most favourable? You know what I mean? If you could pick anywhere, as far as tax rules go and stuff, where would you go and purchase a property? So basically, which one's the best? What do you like?
Right,
yeah, that can be controversial, but yeah, that's good question.
Well, you can dodge it if you like. We'll find out what Mike has for us next when we come back on Property Deconstructed.